All right, everyone. So I'm gonna go over some trades, but before that, I just wanted to quickly harp on a couple of things. And one really important thing that is paramount in trading is, and I don't think it's talked about enough because mostly what you'll hear is trend, right? But it's trade location, how to get trade location. This seems abstract or this or that, or people just think this is support resistance or something like that. But however you get trade location off of the higher time frame, this is the most, from what I've seen so far, it is paramount. Why? Because of many reasons, one of which is that trade location serves as a filter for random signals. So why is this important? Well, if you see what most people do, let's say if you're doing a Wyckoff style trading, right? So you have a lower time frame. What you're going to do is you're going to start looking for springs, up thrusts. See, on a 1 minute chart, a 3 minute chart, or a 5 minute chart, looking for springs and up thrusts and drawing lines all over the place, right? Or you might be looking for breakouts, right? Or you might be looking for effort reward, or you might be looking for a change of behavior, whatever it is that else is there, or low volume pullbacks, whatever, right? Now here's the thing. The trade location is a filter on all of them, making sure that many random signals will be filtered out. Okay, so what I'm saying here is that signal without trade location is highly suspect. If it's just on any chart by itself, it is highly suspect and has high degree of variability. So it's chances that it's going to work, it's not going to work, and it's going to fuck you up. All right, now, I don't know how else to say this. So because trade location is it's kind of like a filter on the random and the ones that work, to filter out a lot of the random ones and a lot of them that are just don't work. I don't know how else to say it. I think I made that point, made this point abundantly clear. The second thing is it maximizes the reward to risk ratio. Trade location always maximizes the reward to risk ratio. If you know what you're doing, you can get this. This is not like 2 to 1. This is not 2 to 1. I mean, you can maximize really almost every day. Maximizes the reward risk ratio. It could be at 5 to 1, or it could be much more than that. Typically, even more than that. So it maximizes the reward to risk ratio. And if you understand what I really mean here by filter, is basically another way of saying this is that increases percentage win. Right? So these are the two most important things in trading in terms of profitability. You have high percentage wins and big reward to risk. So all of that is dependent on trade location. All right, so this is the key. Oh, and there's one third thing that's so damn important too. Now you see, like, everybody when they trade the market, they're taking both sides, buy, sells, lower time frame, higher time frame, all of that craziness, right? So what this does is it if you understand how this is done, what it does is it gives you clarity, gives you directional clarity. Okay? So it actually gives you directional clarity, which, believe me, most folks do not have this when they're trading. What this oversimplification of a trend, saying, okay, it's just higher high, higher low, higher high, higher low, this basically assumes that all you need to do is wait for a higher high and buy, either here or here, and just put your stop here. That's what this model tells you. So, okay, you have a higher low, higher high, you buy here and put your stop here. That is the underlying assumption of this model. We know that this thing is an oversimplification, but that is what higher high, higher low is, in a way, or a trend, what it's making you believe. As soon as you do this, whether consciously or unconsciously, what are you going to do? You're going to wait for a higher high and you're going to put your stop here. You're going to put your stop here and you're going to enter somewhere. If you're doing pullbacks, you're going to enter somewhere around here or here on the breakout. That's what this is going to do. It's going to make you buy the breakout or the pullback. So you're going to buy the breakout or the pullback. So you somewhere around entry, around here or wherever it is, and put your stop here. But we know that trading is far more, challenging. Now, here's the thing with trade location, though, if you understand it, it can help you see this clearer, and it can actually help you see direction clearer if the focus is on trade location and not every squiggle up and down. Otherwise, this right here, it's just not that simple. I think everyone understands that. If it was, everybody would be so damn rich that, we wouldn't be doing all this crap. So the point that I'm trying to say is a trade location, it will give you clarity. Now, how does it do that? Is actually because it is automatically, you have the right perspective, because it requires your mind to see two time frames together. All right, meaning your mind is not just looking at the lower time frame highs and lows. It is looking at the lower time frame highs and lows with the higher time frame together and putting it in context. Automatically it will do that. Trade location, when you focus on trade location, your mind, it's the data is not just coming from one time frame. It is required to come from at least two time frames and put one in the context of the other. So for some reason, that just totally changes perception. It totally changes perception. You know where to wait, you know where to execute, and you know what to look for. Whereas if you're not doing that and you're only looking at one FOMO, FOMO will make you think that it's an uptrend on a lower time frame. Like if you just look, for example, at a 5-minute chart, or lower even, it's a recipe for disaster because you're not getting all the data. There's always one time frame is always within the other. It's always like that. So anyway, I don't know how else to say it, but it gives you directional clarity. And that directional clarity allows you to wait. It allows you to enter. It allows you to know where to enter. And it allows you to look for whatever you're looking at the right spot. And when you do that, you will increase your win rate and maximize your reward to risk ratio. So this is how important this concept is, but I don't think that people realize it, because they just don't. So if you see what signals are doing. Signals are disaster. You know, if you see most people's charts, they're giving signals all over the place, right? Because those signals do not take trade location into the code. A lot of times they can't. So what they do is they're based on conditions. Okay, if the market is making higher high, if the moving average is doing this, if there's momentum using MACD or ADX or some other indicator. These are conditions. So those conditions are on a 5-minute chart, which means they can change on a whim. So I'm not saying that those conditions aren't valid. What I'm saying is that those conditions are missing trade location. Trade location is the major edge. Trade location comes before the signal. It is a prerequisite to the signal, meaning only when A happens, only when you're at the trade location do you then start looking at signals. Otherwise, those signals will have high variability and all the other problems. How do I know? I've done all of this. So I know. All right. So anyway, so that's why trade locations number one thing, and this is the missing piece of the puzzle for many traders. This is the missing piece of the puzzle of how to identify, get the trade location, etc., etc. However they do is, I mean, I'll give you at least like 2 or 3 mistakes that Wyckoff traders usually make. All right, so I'm sure you've seen, what they'll do is they'll just open up a chart, like a 5-minute chart, and I'll give you one example. So let's say they see a trend like this, and then they see this, and they think that this is a break of creek, or a break of resistance, and this right here, okay, blah blah blah, and then they go, so okay, this is a change of behavior, right? See this all the time. So they're using a 5-minute chart, they see this, oh okay, I'm gonna buy the pullback. What happens? Does this, they get happy, and it breaks. They get stopped out, and then it starts doing that. So the one looking at that time frame and looking for behavior, change behavior. This is what Wyckoff traders do all the time, and when they do this, they have higher variability of change of behavior. Okay, so now this is one thing. Now you'll see other, so-called Wyckoff analysts or traders. They'll go and they'll do something like, they'll just start looking at a chart. They'll bring up a chart, and then what they'll do is say, this is the climax. And they start labeling crazy shit in hindsight. They'll say, this was the climax. This was some sign of strength, and then they get into, this must have been the spring, and this is and I would have bought here because after the spring, the test of the spring, blah blah blah, and this is phase phase A, phase B, phase C, phase D. It's all bullshit, right? So you see this all the time. I've seen it, tons of stuff, and I tell you that you cannot trade like this. You cannot swing trade like this either, right? So what's going on? Or they'll apply the schematic to a chart, and basically, first is they have expertise in the schematic. So then they'll cherry pick a chart. Then they'll apply the schematic on the chart. I'm sure you've seen this, right? in hindsight. So this is not trading. Okay, this, I don't even know what it's called, but this is all incorrect approaches to learning. To even learning, it's incorrect. This is not trading. You're not going to become a trader doing this. This is some hindsight analysis, and I don't know, it's even cherry picking the chart to see, make sure that it has a big range or a big base, stuff like that. It just doesn't work. So anyway, I didn't want to get into this, but these are some major errors that you see all the time. When they're trading, they'll say, okay, this is a 5-minute chart, I see a big wave, it must be a change of behavior. You want to see an example, just take a look at yesterday's price action on the ES, NASDAQ. See what happened. It had a very nice change of behavior relative to one time frame without trade location. What happened? It failed. If you want to see all this cherry picking, it's plenty of stuff online, and this labeling. So you're not going to all that. My point here is all of those hindsight behaviors and labeling are missing trade location. The schematic is missing trade location because it only takes one time frame in context. You see? It's missing trade location and only focusing on behaviors. If you focus on behaviors, whatever schematic, etc., without trade location, it is not going to be consistently working. It will have high degree of randomness, and that will create all types of issues with perception of actual direction, and will also create fear. And you'll either be able to execute or you won't be able to execute and have losses and miss trades and all that. So that's why I'm focusing on trade location. Now, I'm not going to get into how I do trade location and all that, but there are plenty of ways to do it, and this is what you need to focus on. This is what you need to focus on, that trade location thing. Right? Once you get that right, once you get trade location right, and then you can see the signals that you apply to that area, or behaviors you apply to that area. Okay, so this thing is going to automatically, when you get this right, your increased wins and all of that, the high reward to risk, directional clarity, and you know what's the best part about trade location is it can be systematically. One second. Anyway, so you see, like over here, I'll just give an example. Trade location is it can be updated via an indicator. It's not rocket science. You can have an indicator that marks trade location based on whatever factors that you use, and it can dynamically be updated. So you're not, every night or in the morning drawing lines all over the chart. You don't need to draw all those damn lines all over the chart and look at this level and this level and that level. Just once you, just take a look at what areas worked in the past. Based on that, based on past information, and I mean significant amount of information and even some basic principles of areas of how to do support resistance correctly, you can actually have an indicator that just does the trade location for you. So you don't have to do all the, all those useless lines, because this is really annoying to have all those lines. I think that's it. So yeah, so bottom line, but the key thing I want to get across is you gotta get trade location. It is a huge error to just look at a chart and just look for behavior, which is what's going on. If you see all the stuff online about Wyckoff, this, that, whoever's teaching it, etc., you'll see the focus is on behavior. So they just open a chart, they'll look at, big volume spikes and say, oh, this is the climax. Oh, what about this? Oh, it broke this. Oh, this is creek. Okay. If you're not getting the trade location right and using at least 2 time frames to see how and really understand how trade location is done, because there are, I don't want to call them, there are ways to do it correctly. All right. Now there are ways on how to get that trade location based on real factors of supply and demand. Real factors of supply and demand, and not just arbitrary, this is a retracement of 58% or this percent or that percent or this fib, or actual, real, quantifiable data that'll show you trade trade location. Now I'm not going to go into all of that. I'll let you work on that and see how it's worked in the past on those high time frame charts, whatever high time frame you use. See how they work. I'll give one that David Weiss used. All right, just so I make, just as a. All right, so what he used? Okay. So how he got his trade location was he used usually a 3-hour chart. All right, so he would use a 3-hour chart, and he would make sure that the 3-hour chart was uptrending or downtrending. All right. So once he did this, right, so let's pick let's say you have downward moving average, whatever, right? So you have this moving average going down, and you have the wave like that. And now he's looking at a couple of things. The first thing he always was mark the test of the breakout and the breakdown. Okay? Now where is his trade location? His trade location was on the up thrust and test of the breakout and breakdown. Right there. And he would repeatedly say that this is the biggest move within the trend. And he would also say is that it happens multiple times. Alright, so this was the trade location, and then he would use the 5-minute chart, change of behavior, plus 3-hour chart, spring or upthrust on the test of a breakout or breakdown. Okay, so it's a 3-hour chart. It would have a spring or an upthrust on the test of a breakout or breakdown. And then when that position on that trade location, you would look for a 5-minute change of behavior. So if you want to see what I'm talking about, you can see his book, Trades About to Happen. The opening of that book is what? Is where to find trades. There's a whole chapter devoted to that, and that is basically trade location, where to find trades. and you're going to see a diagram there that shows you where to find trades. And it's also, I think, on a webinar that he did that you'll get this information. So there's a reason why he did it. Okay, so this is it. All right, this is one. Yes, there are others for sure, but this here is one key one that I'm explaining. And if you get this right, you'll reap the benefits. So this is one style of trade location based off of high time frames, bringing up thrust, test of the breakout breakdown. Of course, there are others. Anyway, take care. Have a good day. Bye.